Welcome to the deep dive. If you're looking for a serious shortcut to understanding the financial nervous system of any company, you've come to the right place.
I think so.
We are diving deep into the fundamentals of financial statements and accounting, what people call the language of business. You shared your sources, and our mission is to unlock the core knowledge that moves you from, a confused bystander to an informed decision maker.
And that's really the critical difference we want to make. People often look at financial statements as just, I don't know, mandatory compliance documents.
Right, just box ticking.
Exactly. But that misses their fundamental purpose. These statements are the main tools a company uses to communicate its own health. By increasing information and reducing uncertainty for investors, for banks, for suppliers, a company gets huge practical benefits.
So this isn't just about reporting last year's performance. It's about reducing risk for everyone outside the company's walls.
Precisely. If I'm considering lending a massive amount of money to, let's say, Company X, and they provide reliable, audited financials, my risk drops a lot.
Compared to a company that's just a black box.
A total black box, right. And that reduction in uncertainty, it's quantifiable. It means Company X can borrow money at a lower interest rate, and it can attract capital from investors on far more favorable terms. The whole system is designed to facilitate trust.
Okay, so let's unpack this financial architecture. Our journey today will break down the three primary statements, establish the core equation that, locks them all together, and then tackle the surprising concepts, the rules of the road that govern how accountants actually think.
Sounds good.
So let's start with the most famous one, the document that captures a single moment in time, the balance sheet.
Yeah, the balance sheet is often called the statement of financial position, and that name, it tells you everything. It's a report of a company's financial status at one exact specified point in time.
Like a photograph.
Exactly like a photograph. Imagine taking a really detailed photo at the close of business on, say, December 31st. It establishes the three core pillars of a company's financial structure.
And those three pillars define the one equation that every business student memorizes.
That's the one. So the first pillar is assets. An asset is, well, it's something the company owns or controls that has a probable future economic benefit.
So things like cash or a factory or even money that customers owe you.
All of that. The second pillar is liabilities. These are the probable future sacrifices of economic benefits. So essentially, the company's debts.
What you have versus what you owe.
Exactly. And the difference is the third pillar, owner's equity. It's the residual interest in the assets that's left over after you deduct all the liabilities.
And that gives us the big rule.
The fundamental rule of accounting, which has to be true for it to balance, is assets liabilities plus owner's equity.
Okay, and for big public companies, we usually call owner's equity stockholders' equity. And what's fascinating is that equity doesn't just come from one place. The sources point to two distinct pathways.
It does, yeah. Stockholders' equity mainly comes from two places. First, you've got paid-in capital. That's the money stockholders put directly into the company when they buy stock.
Simple enough.
But the second one, arguably the more interesting one, is retained earnings. This is the cumulative total of all the profits the company has ever made and kept to reinvest.
Instead of paying it out to shareholders.
Right, instead of paying dividends. So retained earnings really show you a history of profitability and management's belief in its own growth.
And when we look at how the balance sheet is actually laid out, we see the accountant's number one priority, liquidity.
Absolutely. Everything is ordered by how quickly it can be turned into cash. On the asset side, cash is always first, then accounts receivable, then inventory, and way at the bottom you get the long-term stuff like property, plant, equipment.
Really illiquid things.
Right, and intangible assets like trademarks. And on the liability side, they're split into current liabilities, things due within a year, and long-term liabilities like mortgages or bonds.
Okay, now let's get into the philosophy behind the numbers. The source material highlights two really key concepts. First, the entity concept.
The entity concept is a boundary marker. It just says that the financial activities of the company must be reported completely separately from the financial activities of its owners or any other related companies.
Even if they're controlled by the same person.
Especially then. It's how we make sure the company's success isn't being, artificially propped up by the owner's personal checking account or the other way around.
Which I imagine for a huge multinational conglomerate is a nightmare to enforce.
It's a huge challenge. When you have dozens of subsidiaries across different countries and tax laws, defining that precise economic entity and keeping its transactions clean, it takes a lot of work.
And that brings us to the big philosophical trade-off on the balance sheet. Historical cost versus the going concern assumption. This is the one that seems to confuse people the most.
It's critical to understand. Accountants almost always report assets, especially big things like land or buildings, at their original historical cost.
What you paid for it.
What you paid for it. If a company bought a piece of land 40 years ago for $5 million, that's what the balance sheet usually says, even if its market value today is, say, $100 million.
Wait, hold on. If the balance sheet shows a 50-year-old building at its original cost,
Yeah.
isn't that actively misleading me about the company's real value today?
That is the precise tension in the system. It can definitely lead to reported accounting values being way, way less than true market values.
Why do it?
The rationale is that historical cost is reliable, it's verifiable, we have a receipt. If we tried to report everything at current market value, well, those values can be really subjective, they can be volatile, and so they're less reliable.
And this is supported by that going concern idea.
Exactly. The going concern assumption just assumes the company will operate forever and isn't about to be liquidated. So, since you're not selling the asset tomorrow, its liquidation value is less important than its verifiable, reliable historical cost. We trade relevance for reliability.
Fascinating. So the balance sheet gives us the snapshot, the what.
Ah.
But to get the story, we need to know how the company performed over time. That takes us to the income statement.
Right. The income statement describes a company's financial performance over a period of time, a year, a quarter. If the balance sheet is a photo, the income statement is the movie of everything that happened between two of those photos.
And its main goal is to figure out net income.
Correct. Net income is calculated by taking a company's revenues and subtracting its expenses. Revenues are assets you generate from your core business, and expenses are the assets you consume to make those revenues.
And it also includes other things, right?
Yes, crucially, it also reports gains and losses, which are from activities outside the company's normal operations. Like if you sell off a warehouse you aren't using, that's a gain, not revenue.
Okay, so business life is this continuous flow, but investors need updates. So accountants have to arbitrarily chop it up into reporting periods. This makes the timing of revenue super important. Let's talk about revenue recognition.
Revenue recognition is the rule book for when you can actually claim a sale on your books. And this is where we have to introduce a foundational concept called accrual accounting.
Okay, hold on. Let's break that down for a second because that's a
Yeah,
non-cash idea, right?
totally. Accrual accounting means revenue is recognized when it is earned and expenses are recognized when they are incurred, regardless of when cash actually changes hands.
So the income statement isn't tracking cash.
It is not. And under these accrual rules, revenue gets recognized only when two big conditions are met. First, the work has been substantially done, the product's delivered, the service is performed, and second, the collectibility of the cash is reasonably assured.
So if I'm a construction company and I send a huge invoice, but I know my client is about to go bankrupt, I can't recognize that revenue.
You cannot. Even if you did the work, if that assurance of payment isn't there, you can't put it on your income statement. That rule prevents companies from, faking sales.
And once you get that net income number, the metric that everyone quotes that drives stock prices is earnings per share, or EPS.
EPS is the key number for investors. It's just the total net income for the period divided by the average number of shares of stock that were outstanding. It gives you a clean per share measure of how profitable the company was.
Right, so we have the snapshot, the balance sheet, and we have the performance report, the income statement. But, neither of them really tells me where the actual physical cash went.
And that leads us to the third required document, the statement of cash flows.
Finally, the cash.
Yes. This statement is designed specifically to fill that gap. It details exactly how a company got and spent its cash during the period, cutting through all the non-cash stuff from the income statement.
Yeah.
It's probably the most reliable statement because, well, cash is cash. You can't really fake it.
And all the cash movements have to be sorted into 3 buckets.
3 mandatory buckets. First, cash flows from operating activities. This is the cash from your day-to-day business, selling stuff, paying rent.
The core business.
The core business. Second, cash flows from investing activities. This is cash used for buying or selling long-term assets like a new factory or old equipment.
And the final one is about the capital structure.
Yep. cash flows from financing activities. This is all about how cash is raised from or paid back to creditors and investors. So, issuing stock, paying dividends, taking out loans, paying down debt.
What's interesting is the sources say that while cash in versus cash out seems simple, actually preparing this statement is really hard. Why?
It's because our entire accounting systems are built to calculate that accrual-based net income we just talked about. So to create the cash flow statement, the accountant has to start with net income and then one by one undo every non-cash transaction that's in there.
So you're reversing the logic.
You are literally reversing the logic. You add back non-cash expenses like depreciation, you subtract non-cash gains. It's a big reconciliation exercise to get back to pure cash.
Okay, so we've got the three statements. But if we stop there, we're missing half the picture. We have to talk about context and trust. Let's talk about the part most people skip, the notes to the financial statements.
Skipping the notes is. It's malpractice for any serious investor. They are not an appendix. The rules say they are an integral part of the financial statements. They provide all the context.
Like what kind of context? What's hiding in there?
You usually see four types of things. First, a summary of their accounting policies. How do they value inventory, for instance? Second, more detail about big numbers on the statements. Third, disclosure of really important stuff that's not on the statements at all, like a pending lawsuit.
Wow, okay.
And fourth, any extra disclosures that are required by the big regulatory bodies.
And for our listeners, who are those key bodies setting the rules here in the U.S.?
The main ones are the Financial Accounting Standards Board, or FASB, which sets the rules, that's GAAP, and the Securities and Exchange Commission, the SEC, which enforces those rules for public companies.
So we have all these rules, but how do we trust that companies are actually following them? That brings us to the external audit.
An audit by an independent accounting firm is what builds that confidence. Now, the audit report doesn't guarantee the company is a good investment or that it's totally free of fraud.
So what does it do?
It gives an opinion. It assures users that the statements fairly reflect the company's financial status in accordance with GAAP. It's an assurance of fairness and rule following, not an endorsement of the business.
So the auditor's main motivation is protecting their own reputation.
Their reputation and avoiding massive lawsuits. That's a pretty powerful incentive to do a rigorous job.
Okay, now for the really deep stuff, the philosophical concepts. Let's dive into that constant tension you mentioned earlier, relevance versus reliability.
This is probably the biggest trade-off in all of accounting. Relevant information is timely and useful for predicting the future. Reliable information is verifiable and accurate. You can't have perfect relevance and perfect reliability at the same time.
Give me a practical example.
Okay, a high-tech patent. To be highly relevant, you might report its estimated current market value based on future sales projections. That's timely, but it's also a total guess, so it has low reliability.
Right.
To maximize reliability, you'd report it at what you paid for the legal fees to get it 10 years ago. That number is verifiable down to the penny, but it's completely irrelevant for predicting the future. So accounting rules force a compromise.
And what's in place to counter the natural optimism of management, who always want to make the company look good?
That's the job of conservatism. It's a simple rule to counteract hype. It says you must recognize all probable losses as soon as you think they might happen. Book the bad news immediately. But you only recognize gains and revenues when they are absolutely certain.
A built-in brake pedal.
A necessary one. Then you also have materiality. This is why a $5 error doesn't matter, but a $5 million one does. Amount is material if it's large enough to actually influence the decision of an investor. If it's not, it's immaterial, and accountants can use a simpler, more convenient method to account for it.
And finally, the concept that proves this isn't just three separate reports, but one cohesive story. Articulation.
Articulation is this beautiful idea that the three statements are mathematically linked. The net income from the income statement flows directly into the retained earnings on the balance sheet. The final cash balance on the statement of cash flows has to match the cash number on the balance sheet. They articulate. They tell one story.
We've covered a ton of ground. From the snapshot of assets, liabilities plus owner's equity, to the performance report, to the role of audits and notes. And we've seen that understanding this financial narrative means grappling with that tension between what's relevant and what's reliable.
Right, and this whole structure gives you the power to see not just what a company reported, but how it got there. That combination of rules like conservatism and the trade-offs they have to make, it all shapes the final picture. It lets you read between the lines.
So what does this all mean for you as you look at your next set of financials? Here's the thought. Since we know financial statements often report assets at historical cost, making accounting values much lower than market values, how might that practice of conservatism influence a manager's internal decisions? Knowing the public numbers are already fundamentally conservative, does that make them more or less likely to take big risks on growth? Something to mull over.